Welcome for another interesting lesson today as we get to do something to do with the marginal and absorption costing, which are actually some techniques as applied in any particular business organization. And we hope that this particular class is going to be useful to those people who are preparing for the management accounting or the cost accounting, either for the CASNEB or some other papers outside. Now, when we talk about marginal costing or absorption costing, we are talking about techniques of reporting profit by any given firm. So a firm will normally report its profit out of its operations or production department capacities using these two methods. And just to point out the key difference between these two costing systems, when you talk about marginal costing, the word margin means an additional or extra cost. It is the cost per unit, which is mainly the marginal cost. And marginal cost refers to the cost that a particular organization will incur when they produce an extra unit of a product. But then now, under absorption costing, the unit cost is the total cost. And from our understanding, we know that for you to get total cost, we normally add the variable cost plus the fixed cost. So what actually makes the difference between these two costing methods is the element of the fixed cost, which will contribute to something to do with the overhead absorption, the absorbed overheads. We shall go into details and look at how we are going to compute that. So we have a sample question illustration that we're going to use in illustrating the two systems. Like we're told that Project Limited manufactures a single product. The standard cost per unit is as follows. Now the word standard cost means cost that is normally standardized in such a way that these particular products or these particular variables that are put into the production facility are always at their facilitation. So direct material is 8 units, direct labor is 30 shillings. We could also have direct expenses, but in this case we don't have. Then we have the variable selling cost. So variable selling cost, it means that is the cost for selling one particular unit of a product, which is 2 shillings. Then you're given additional information. The budgeted fixed production overheads per annum amounted to this 7.2 million. These are the budget estimates. Now, these budget estimates will help us to either get an over-absorbed overhead or under-absorbed overhead. As we know that overheads are over-absorbed if a particular firm or a production capacity uses more than what was budgeted for. But if it uses less than, then it means it has been under-absorbed. And if you look at our formula, we always add over-absorbed overheads or we less under-absorbed overhead. We shall look at that one as we get to that. Then we're told that the normal production level per annum is 2.4 units. So these 2.4 units affects both the direct materials as well as direct labor. Variable selling cost does not depend on the production because these are selling units which are they come later after the products have been sold. Then how in the month of April 2013, the number of units produced and sold was to 40,000 and 200,000 units respectively. So it means 240,000 was produced and then 220,000 was sold. So it means the number of units sold was actually 200. Then the fixed selling cost per annum per month was 1.5 million. selling price per unit is 50 shillings. So it means for us to get the number of sales, we shall multiply this 50 by the units, which is 200 that was sold. Then you're told there are no opening inventories. At the moment we don't have opening inventories. These are actually some of the reasons why we are going to have differences in the net profit as per the marginal costing as well as absorption costing. So the part of the question is asking us to prepare an income statement under absorption costing as well as marginal costing. But before we go into that, I want us to analyze this standard cost for each and every. So we are going to have, when we have the marginal costing, and then we shall have the absorption costing. Under these two methods, I want us to talk about now the standard cost. For marginal costing, we have direct materials. For direct materials is 8, direct labor is 30 units or shillings, 30. Total we have 38. Likewise, we have the same for absorption costing, 8 direct material, direct labor should be 30. And then there's an element of a fixed cost, or if you like, the overhead absorption rate. Now, for us to get the overhead absorption rate, an overhead absorption rate refers to the ratio. It refers to the ratio of the overhead budgeted, which is normally, this one is equal to the ratio of the overhead of budgeted, or simply the budgeted overhead versus the actual overhead that was incurred. What you budget versus what you actually produce. And you're told that the budgeted fixed production overhead per annum was actually an amount of 7.2 million. So we are going to have 7.2 million. And then the annual, what was actually produced was 2.4 million. When you divide these two, you're supposed to get a value of 3. So we normally add that 3 together with the direct cost and the fixed, direct material and direct labor to get an amount of 41. So for our absorption costing, we have unit standard cost amounting to 41 shillings. That is the difference. Now, I want us to go to the preparation of income statement now. Income statement under marginal costing. In which we are actually going to follow some process or some step that we have here. Like the format that I've just given you, we normally have the sales. So we shall have the sales. When you have the sales, we are told that the selling price per unit is 50 and 200 units were sold. So it means we shall have 200 units sold times 50, of which we are going to have a value to do with it's a value to do with 10 million. That is 10 million. After that, you're supposed to less now the variable cost. So we less variable cost, and you should know that variable cost has many components. So variable cost has components of one of them we are going to factor in the opening stock. And we are told that opening stock, there are no opening stock. So our opening inventory or opening stock is 0 times. And you should know that we multiply that opening stock times the standard units that was computed under marginal cost, which is 38, that is the direct material plus direct labor, times 38, we get a value of 0. And then later we shall have the direct material now. Direct material. Remember, direct material is a component of units that were produced. That you're told that the normal production level per annum is this one. Information number 3. In the month of April 2013, the number of units produced was 240. So units produced was 240,000 times the 8, which was actually the units that were as per the direct material. And when you multiply these two, you're supposed to get a value of something close to 1,920,000. So this one was 0. You shall have 1,920,000. And then you factor in direct labor again. Direct labor. Same units that were produced, labor forms part of the unit because labor is a factor of production. So you use the same units times 30. This is 30. When you multiply the two, we should have a value of 7,200,000. 7,200,000. Then later we are supposed to factor in direct expenses, in this case we don't have the direct expenses, so we shall just add these two, and when you add the two, when you add this one, you get a value of 9,120,000. Alright, then now when you talk about now the variable production cost or the variable product cost, in this case we don't have any variable product cost, we only have the variable selling cost. So we shall go to the closing stock. So we shall again further less the closing stock. And why are we lessing closing stock? These are what we have. This is what is available. This is what is available. And you want to see actually what was sold. When you have an amount of goods available at the end, or when you have an amount of goods available to be produced, and then at the end you have some closing stock, it means we less what is remaining at the end to actually realize or to actually find the value that was consumed in the production or what was used in the production. And how do we actually get this closing stock? Closing stock, we are going to do some computation which involves if 240 units were produced and 200,000 are sold, it means the difference is what is remaining at the end. So it is 240,000 what was produced minus what was sold. We sold that, so it means the difference is what has actually not been sold, which happens to be 40,000. And then that 40,000 we factor in, because closing stock comprises of both direct material and direct labor. It means we use the combined standard units of 38. So it is the 40,000 times 38. And when you do that one, you get a value of 1,520,000. 1,520,000. Because we were lessing, we are supposed to less that. Then factor in further. When you less this one from that, we get a value of 7,600,000. Remember, we have now the sales, because after that one we shall get to what is known as the net contribution. Now 10,000, now this was 10 million, sorry, 10 million minus 7.6 thousand should give us our value of 2,400,000. Now we have the net, this is now the gross contribution. Gross contribution, the word gross means some element of cost has not been deducted. So it means we are supposed to deduct those costs to be able to realize the net profit or net loss, if any. So what does our formula say? We talk about now the fixed cost. Now we less the fixed cost, or less other variable cost first. We shall combine other variable cost or other fixed cost. So when we go further and say that we less other variable costs. And what are these examples of our variable cost? One of them being the variable selling cost. Variable selling cost, which was 2 shillings per 1 unit. And how many units were sold? We sold 200,000. So it should be 200,000 times 2. We get a value of 40,000. You get a value of 400,000. We're supposed to less that one. Then after we don't have any other variable cost, we shall now go to the fixed cost. We only have the variable cost. So after lessing the variable cost, which you only have one, we shall now less the fixed cost to be able to realize either there's a net profit or a net loss. So if we go further, now less the fixed cost, and our fixed cost in this case are given as an example. You're told that the budgeted fixed production overheads per annum amounted to 7.2 million. And remember, we are talking about income statement for the month of April. So it means we are supposed to talk about now the budgeted, the fixed production overhead, which was per annum an amount of 7.2 million. You divide by 12 to get what was actually consumed per month, because that is per annum, and we get a value of 600,000. Again, we less that one. Any other fixed cost here, we are told that the fixed selling cost per month amounted to 1.5 million. Now because it is per month, we just subtract it the way it is. So we are talking about now fixed selling cost per month, which is an amount of 1.5 million. Again, we less that value. So when we less all these from that, we get a value of negative 100,000. And this one typically illustrates that there is some element of net loss. So that is a net loss to this particular business because we have more expenses or more both variable cost and fixed cost that was incurred as compared to the gross contribution. Or you simply say you can talk about now the net loss is now without this one, but if you use the bracket you can write net profit. When you write net profit and indicate the bracket, it simply means that that was a loss in its essence. So net loss should be without now the bracket. That is now how we prepare the marginal costing. I would now want us to go ahead and look at how we can prepare the absorption costing, which actually has some slight adjustments that we are going to make in comparison to the marginal, comparison to the marginal costing. And now under absorption costing, so we talk about now the income statement. Under absorption and absorption costing, and we are again going to follow the formula or the steps that are going to guide us into arriving at our working. And when we look at the steps again, we normally have, because we're talking about an element of absorption, again we have the sales. Now we shall have the sales. After having the sales, so we shall have the sales. We had the same working of 50 shillings times 200,000 units produced. We got a value of 10 million. Then now we less. Now we don't talk about variable cost. We less cost of sales. And cost of sales is a component of one, opening stock, which was 0, and we multiply by the standard units, the one that we computed for this particular absorption costing as 41 after getting the overhead absorption rate. So we use 41 instead, and then we get a value of 0, of course. Next, now we go to the production overhead. We again less the production overheads, and production overheads here comprises of 1, the direct material, just the same case as in marginal costing. And how many units were produced? Units of 240,000 times 8. So we have 240,000 units were produced times now 41, not now 38, is now times 41. And then now we get a value of an amount given to, sorry for that, 41 is only affecting the opening stock as well as the closing stock. So for direct materials we are going to have 8, the way it was 8, and you multiply the 2, you get a value of 1,920,000. Then again we have direct labor, and it depends again on the number of units that were produced times labor standard units of 30. again we get a value of 7.2 million. Then now, what makes the difference? Before now we factor in the closing stock, we now talk about what is known as absorbed overhead. Absorbed overhead. This is now what brings the difference. Absorbed overhead. Remember, if you look at our formula, after variable cost, we don't have the variable production overhead. Now we have the fixed production overhead. Now the fixed one here is the absorbed overhead. The one I've highlighted is actually the absorbed overhead. And for us to get the absorbed overhead, we are going to talk about units that were produced, which is again 240,000 times the overhead absorption rate, which was 3. Remember, we computed our overhead absorption rate as 3. So it means we get a value of 720,000. A value of 720,000. When you add these 3, you're supposed to get a value of 9,840,000. That is now when now we less now the closing stock. So we are supposed to less now the closing stock. Closing stock again, we had 240 that was produced, 200 was sold. So difference in 40,000. It is now 40 times the standard units of 41 now. So it should be 40,000 times 41 as the standard units, and we get a value to do with 1,640,000. When you subtract these two, we get a value of 8 million. So when you subtract these two, we get a value of 8,200,000. This from this. Then now this is now what you subtract from the sales. Subtract from the sales, you get 1,800,000. Please confirm with me. And this is our gross profit. Now, in marginal costing, gross contribution will be referred to as the gross profit, because actually we are talking about now cost of sales, because we normally have sales minus cost of sales should normally give us the gross profit in any typical income statement. Then now, looking at the formula again, what brings the difference again is we either add if there is an overabsorption, but if there is an underabsorption, we less that value from our gross profit before we proceed to the next steps. So how will we know whether there is an overabsorption or underabsorption? Remember, we shall get the working here. We look at the absorbed overhead. Overhead that was absorbed is 720,000. Okay? But now, under the marginal costing, the fixed production overhead, which was actually incurred, was 600,000. What was incurred, what was budgeted for is 600,000. This was per the budget, but now what has been incurred is 720,000. So it means excess was absorbed, which is an over absorption. So it means we are going to add. We will not have that closure for subtraction of and absorbed overhead. So we add over absorbed overhead. And how do we get that? The overhead that was actually absorbed, 720 minus what was budgeted for 1 month, which happens to be a value of 120,000. When you add these two, you're supposed to get an amount of 1,920,000. And then now we proceed later now using the formula. After that, we now less other costs. Other costs upon they should now be variable selling cost and fixed cost. So when we go ahead and try to less other costs, and I'm talking about the variable cost and the fixed cost combined. The first one we have is the variable selling cost. Variable selling cost which was an amount of 200,000 units was sold at 2 shillings. So you simply multiply 200,000 units sold at 2 shillings, you get an amount of 400,000 units. The other cost that we are going to less should be fixed selling cost. The fixed selling cost, fixed selling cost per month, which is an amount of 1.5 million. Remember, this fixed production overhead cannot be subtracted or deducted here because it was actually absorbed and reflected in this particular working for us to arrive at the gross profit. So we normally have that one. So anything else that we are going to deduct would actually be the fixed administration cost, which is not in this question in this case, or fixed distribution cost. So production cost we don't subtract because have been absorbed in our working and we have illustrated. So when you add these two, you're supposed to get a value of 1,900,000. When you subtract that particular value from the other one, you get an amount of 20,000. And this one being a positive number, it is a net profit. Thank you very much, and I hope that you are actually enjoying our lesson. Having a look at these two costing methods, we realize that the net profit or net loss as per the marginal costing, which is a negative 100,000, is actually different from the net profit as per the absorption costing of 20,000, and therefore it calls for what is known as reconciliation of these two profits. So we normally reconcile the two profits if they don't agree or if they're not the same. And the reason why they were different is because of the different in valuation of either the opening stock or the closing stock. That is why our reconciliation here is going to factor in the element of, like when we talk about the profit as per the marginal costing, we normally add the differences in the closing stock, then less differences in the opening stock. The answer that you get should be the profit as per the absorption costing. Let us see if that one is true. Now, you shall use the first method. So method 1, this is now under a reconciliation statement. Profit as per marginal costing was given as negative 100,000, is negative 100,000. We are supposed to add difference in closing stock. So we actually take the highest value there, which one has the highest closing stock. Now marginal costing, its closing stock is 1.5 to 1.520 million. Then absorption costing, the closing stock is 1.640 million. So we use this highest value for under absorption costing 1.640 million minus 1.520,000. You can actually compute and see what comes in. 1.640 million minus 1.520, you get a value of 120,000, which is positive. We are adding it to a negative number. It is the same as subtracting 100,000. We get a value of 120,000. And this one should be the profit as per the absorption costing. Profit as per absorption costing should be the answer, because actually we have that net profit and absorption costing as 20,000. So this one should be the profit as per absorption costing. Or alternatively, we have another method. We could use method 2. It is method 2 now. You can start now with the profit as per marginal costing. As per marginal costing, which was actually negative 100,000 still, we add the difference, we add the overabsorbed overhead. So it means overabsorbed overhead, absorbed overhead. The reason why we're adding this one is because it is only featuring in the absorption costing and not in the marginal costing. And we had an overabsorbed overhead of 120,000. So we add 120,000 again. Of course, when you add that value is the same as subtracting the negative from that particular value, and you get an amount of 20,000 again, which should be the profit as per absorption costing. Thank you very much for your patience, and I hope that you found this video helpful. And please don't forget to subscribe and share.